What if I told you your portfolio could pay you every single Friday? Sounds too good to be true, right? Stick around, because by the end of this video, you'll know exactly which weekly paying ETF I'd actually put my own money into, and just as importantly, how it should actually fit into your existing portfolio. I'm Rashid, I'm a CPA, a chartered professional accountant, and I hold a master's in finance. You'll find the full article, with all the details, linked in the description below at wiseinvestors.com. Now let's get into the ranking of the top 7. So can these things actually replace a paycheck? Here's what's wild. Some of these funds are managing billions of dollars now, and more investors are ditching monthly dividends for weekly ones every day. But here's the catch nobody tells you up front. These 7 ETFs are built completely differently, and depending on your age, your goals, and what you already hold, some of them belong nowhere near your portfolio. Let's break down which is which. If you've been on YouTube or TikTok lately, you've probably noticed these weekly ETFs everywhere. There's a reason for that. Younger investors want cash flow they can reinvest and compound faster. Retirees want something that feels like a real paycheck to cover living expenses. And 2 companies, Yield Max and Roundhill, basically built an entire industry around this in just a few years. But popularity doesn't tell you whether a fund fits your situation. That's exactly what we're digging into. Before we rank anything, let's quickly demystify how this actually works, because it's not magic. Take a look at the chart. The fund buys stocks, sells call options on them, and hands you the premium as cash every week. Simple enough. But here's the part most people skip past. The bigger that weekly check, the more aggressive the strategy behind it usually is. A higher yield almost always means the fund is writing options on a larger portion of the portfolio, or using shorter dated, more aggressive contracts to generate more premium. That's not automatically bad, but it does mean less upside if the stock rallies, and more exposure if it drops. This is why understanding how the income is actually generated matters so much. It's what separates an informed investor from someone just chasing a number on a screen. And how much of that added risk you can actually handle depends heavily on where you are in life. Someone in their 30s can absorb a rough year very differently than someone already living off their portfolio in retirement. Okay, this next point is honestly the most important thing in this entire video, and it's really a portfolio construction question. Some of these ETFs spread your money across dozens of companies. Think of these as something you could reasonably build a core position around. Others bet everything on one single stock. Those work best as a small satellite slice next to holdings you already have, not as a foundation. Mixing those 2 roles up is probably the most expensive mistake I see new income investors make. Keep this in mind as we go through the rankings. Let's start with the diversified side. QDTE, the Roundhill Innovation 1000 DTE Covered Call ETF, takes the top spot here. Notice how close its 1-year and 3-year returns are. That consistency makes it a solid core holding, especially for someone who wants steady income without babysitting their portfolio, like a retiree or a more conservative investor. FEPI, the Rex Fang and Innovation Equity Premium Income ETF, comes in second with a similar story, and it pairs naturally alongside QDTE if you already own broad tech exposure and want to layer in income without doubling up on risk. ULTY, the Yield Max Ultra Option Income Strategy ETF, pays the highest yield of the 3, but given what you'll see on screen about its returns, I'd treat it more as a small add-on than a cornerstone. We'll get into why in a minute. Now let's flip to the single stock funds, and here's the key portfolio question. Do you already own the underlying stock? NVDY, the Yield Max NVDY Option Income Strategy ETF, tied to NVIDIA, is the biggest fund in this comparison, and it only really makes sense if you're already bullish on NVIDIA and want to squeeze extra income from a position you'd hold anyway. CHPY, the Yield Max Semiconductor Portfolio Option Income ETF, quietly delivered the best 1-year performance of anything we're covering today, and because it spreads across 30 semiconductor names, it can slot in as a sector satellite rather than a single company bet. TSLY, the Yield Max TSLY Option Income Strategy ETF, rides Tesla's volatility, and MSTY, the Yield Max MSTR Option Income Strategy ETF, is linked to Bitcoin through MicroStrategy with a yield so high it almost doesn't look real. None of these 4 are core holdings. Think of them as small, conviction-based slices, sized to what you could stomach losing. We'll come back to MSTY, because its story is not what you'd expect. Here's something a lot of investors overlook. and it's costing people real money, especially retirees relying on these distributions to pay bills. A massive yield feels exciting. It looks amazing on a thumbnail, but a big number on the label tells you nothing about whether that income is sustainable enough to actually plan your budget around. And here's the piece that matters more than people realize. The quality of the underlying stocks in that portfolio is always going to be your best friend. What the fund actually owns matters more than how much option income it's squeezing out of it. A high yield is perfectly fine when it's coming from quality names, think NVDY, or a diversified basket of solid companies. It's a very different story when that same yield is coming from something speculative or unstable underneath. So before you buy any of these, ask 2 questions. What's actually inside this fund, and where is that yield coming from? Can I count on both of those next year too? This is the slide I really want you to pay attention to, especially if you're nearing or already in retirement. MSTY has the highest yield in this entire video, by a mile. Sounds incredible, right? Except investors in this fund have lost more than half their money over 3 years. And here's something worth asking yourself. What business is MicroStrategy actually in? Owning Bitcoin on a balance sheet doesn't necessarily make you an operating business. Bitcoin itself is already a highly speculative asset, and MSTR stock trades on top of that speculation. So with MSTY, you're layering options income on top of a stock that's speculating on an asset that's already speculative. That's 2 layers of speculation stacked on top of each other. Now this is just my personal take, but unless you're fully convinced this is a genuine turnaround story, I'd personally be very cautious about putting money into an option income fund built on a highly speculative stock with no real underlying business. If this were sitting inside a retirement portfolio meant to fund your living expenses, that kind of drawdown could be devastating. When a yield gets this extreme while the fund bleeds value, that's usually your own capital being handed back to you, not real profit. Alright, here's the ranking you've been waiting for, from best to worst. QDTE takes the top spot, a strong core holding for income-focused and retired investors. CHPY comes in second, a solid satellite for growth investors comfortable with sector concentration. NVDY holds strong at third, best for those already bullish on NVIDIA. FEPI lands at 4 as the steady, conservative pairing alongside QDTE. ULTY sits at 5, a small income add-on at best. TSLY comes in at 6, suited only to investors with high conviction in Tesla and a high risk tolerance. And rounding out the list at number 7, you guessed it, MSTY, the highest yield and, unfortunately, the worst fit for almost any portfolio, retirement or otherwise. So which one actually belongs in your portfolio? If you're retired or you need dependable income, QDTE and FEPI are your lane. They're built to be core holdings, not speculative bets. If you're younger and growth-oriented, CHPY and NVDY can work as a smaller slice alongside your existing equity positions. And if you already run a higher risk portfolio and can genuinely stomach volatility, ULTY or TSLY might earn a small spot. Just size it accordingly, and go in with your eyes wide open. So here's the big takeaway from everything we just covered. The highest yield is almost never the best investment, and no ETF should be added to your portfolio just because the yield looks impressive. The funds that actually build long-term wealth are the ones balancing sustainable income with real total return, and the right allocation always depends on who you are as an investor. I break down every number, source, and how these fit into sample portfolios in the full article. Links in the description at wiseinvestors.com. If this helped you make sense of these ETFs, drop a comment and tell me what kind of investor you are, and subscribe for more breakdowns like this one.